the inflation that we're experiencing now is going to kick into a much higher gear during the next economic downturn. That's what nobody understands. Everybody just assumes that when the economy weakens, so too will inflation. No, the weakening economy is going to strengthen inflation because inflation is the expansion of the money supply.
Stocks have struggled in recent days due to some better than expected economic data and more hawkish talk from Fed officials. This has revived fears that the Federal Reserve could make a mistake and raise rates too high and keep them there too long, sparking a recession. In this video, Peter Schiff points out that the markets are worried about the wrong mistake. Peter said the market reaction to Jerome Powell's recent speech got him thinking about the possibility of a Santa Claus rally. The markets ignored Powell's hawkish talk about interest rates going higher and staying there longer and focused totally on the prospect of a smaller rate hike in December. But in the last few days, several Fed members have repeated Powell's messaging about having to go higher for longer. The market perception is that this stronger than expected economic data will prevent the Fed from recognizing that the inflation threat has subsided. That will lead to the Fed making the mistake and raising rates too much and leaving them too high for too long, causing an unnecessary recession. Peter said, of course, we'll occasionally get data that is stronger than expected. But most of the data has been weaker than expected. And a lot of the strong data, for instance, the non-farm payroll report, is only superficially strong. When you dig beneath the surface, you find a different story. He also pointed out that annualizing the 0.4% month-on-month CPI increase we had in September and October comes to 5%. While that's lower than the 8% rate we saw earlier this year, it is still a far cry from the Fed's 2% target. Nothing the Fed had done thus far is going to succeed in bringing inflation down to 2%. The markets now expect the next rate hike will be 50 basis points instead of 75, followed by a 25-point hike. After that, the markets think the Fed will be finished tightening. We will now get into the video and listen to Peter Schiff as he explains why our current train of thought is flawed and the actual risk we should be looking forward to. In the meantime, ensure to like the video, subscribe, and drop your comments below.
What got me thinking that we could have this Santa Claus rally was the way the market reacted to Powell's speech last week, where despite the Fed chairman delivering a hawkish speech, the market just shrugged it off anyway. Well, what got the sell-off started on Monday, and then some follow-through again today, were some more statements from some Fed guys about the prospects of the Fed having to go higher for longer when it comes to interest rates. And in fact, that point got hammered home yesterday with the release of some economic data that was actually stronger than the markets had been anticipating. First of all, we got the Chicago PMI for November. And this one wasn't necessarily a beat because I'm not even sure what they were looking for. But the index came out at 46.4 and the service index came out at 46.2. Now, that one was actually a slight miss because they were expecting 46.3. But again, anything below 50 represents contraction. So regardless of what investors were expecting, that was definitely a weak economic number. But the surprise came when we got the ISM Services Index for November, which was supposed to come in at 53.5, which would have been a decline from the 54.4 from the prior month. And instead, it came out at 56.5. So instead of going down, it went up. And not only did it go up, it was above the upper end of the consensus range, which went from 51.5 to 56. So this was definitely a stronger data point than the markets had been expecting. We also got a beat on October factory orders, which were supposed to rise by 0.7, and that would have been an increase of the 0.3 in the prior month. But instead, we had an increase of 1. And so that too was a beat. And that was a 1-2 punch because as soon as these numbers came out, the S&P futures sold off sharply and they never recovered. Gold dumped. I think on the day, gold was down about $30 all of the losses came as a result of that release. And the idea that this strong economic data is going to prevent the Fed from recognizing that the inflation threat has subsided, and it's going to result in the Fed making a mistake and raising rates too much or leaving them too high too long and causing this unnecessary recession. And stocks are getting hurt for a couple of reasons based on that. One, of course, the higher interest rates are automatically a negative for stock market prices because of the impact on valuations, because the higher the rate is, the lower the discounted present value of future earnings, which is what stocks represent. But also, if the Fed causes this unnecessary recession, that will depress earnings. And so stocks have a lower value when they have lower earnings. And of course, corporations have a lot of debt. And so higher interest rates directly subtract from earnings by running up the interest expense. So all of this is scaring the stock market. But of course, the reality is we're already in recession and we don't have a strong economy. Yes, every once in a while, we're going to get some data that comes out stronger than expected, but most of the data is weaker than expected. And even the data that is stronger than expected, like the most recent non-farm payrolls report, and I went over this on the podcast, but all of the strength is superficial. Look beneath the surface, and the reality is weakness. It reminds me of Sam Bankman-Fried. I mean, we've got a Sam Bankman-Fried economy. We've got a Sam Bankman-Fried job market. Because if anyone had bothered to look beneath the surface of what was an obvious fraud, his whole empire would have been revealed as a scam. Everybody just accepted the fact that this guy was worth close to $30 billion and that he had all the money to do everything he was doing. Nobody bothered to question how it was possible that this guy could possibly have so much money based on the business that he claimed to have. Nobody really looked beneath the surface, and nobody questioned some of the ridiculous statements that he was making and the self-serving nature of a lot of the companies that he was rescuing. He was basically rescuing himself. He was probably trying to prevent bankruptcies of other crypto companies that were involved with FTX from revealing the underlying problems at FTX. But the same thing is true with respect to the U.S. economy or the labor markets. Don't accept the numbers at face value. Dig a little deeper and look at what's actually happening. Because if you do that with the jobs numbers, as I've been doing on this podcast, the jobs market isn't strong. The jobs market is weak.
Even if the Fed continues to hike rates, it'll never catch up to an inflation curve it is miles behind. Because, as I've been saying, the only real way to fight inflation is a two-pronged attack, which would include positive real interest rates, and we need cooperation from the U.S. government. We need to see cuts in government spending, something that's not going to happen. Government spending is going to continue to increase, and so will the deficits that are making that spending possible. Peter pointed out that we still have stimulative monetary and fiscal policies with negative real interest rates and increasing budget deficits.
And the risk that everybody is worrying about is once again the wrong risk. It's not that the Fed is going to raise rates too much. It's that they're not going to raise them enough. It's that they're going to pivot too quickly. It's not that the Fed is going to mistakenly believe that the economy is strong and then to overestimate how high inflation will be. It's the weak economy that's going to cause inflation to be higher, because as the economy weakens, production will decline, but money printing will expand. In fact, at some point, the Fed will pivot in response to a much weaker economy than it expected, and that's when the dollar is really going to tank. And that's when consumer prices are really going to take off. The inflation that we're experiencing now is going to kick into a much higher gear during the next economic downturn. That's what nobody understands. Everybody just assumes that when the economy weakens, so too will inflation. No, the weakening economy is going to strengthen inflation. because inflation is the expansion of the money supply. And the weaker the economy gets, the more the Fed is going to expand the money supply to try to stimulate it. And as the return of quantitative easing causes a mass exodus out of the US dollar from foreign central banks and private holders, then the falling dollar is going to push consumer prices up dramatically, also increasing the size of our trade deficits and our current account deficits, creating a self-perpetuating spiral of inflation and economic weakness.
According to Peter, the Fed is going to claim, falsely, that it will claim that it is making progress on inflation. And the markets will accept that. They're not going to question that excuse. It will at least pass the smell test of plausibility because most people won't dig deep enough to see what's going on. They want to hear what they want to hear. And so, they will buy this. Because the Fed now has a plausible excuse, the markets are buying stocks, and they're buying bonds, and they're dumping dollars, and they're buying gold. But the reality of this report means that the Fed is in the process of pivoting even though it's not even close to winning its fight against inflation. And it's ultimately going to do a hard pivot even as the inflation rate accelerates and makes new highs because the recession that we are already in is going to get much worse. What do you think of Peter's assessment? Do you feel cheated by the Fed too? Let us hear your opinions in the comment section. Also, remember to like the video, subscribe, and turn on notifications. Thanks for watching.
Trillion of these. Are you not going to hit that bid? Of course you are. The Fed is saying, look, we're going to buy all these treasuries. So if you don't sell them to us and everybody else does, the ones you have are worthless because the treasury is only worth what the dollar is worth. And if we're going to print it into oblivion, then everybody's going to dump. So I think you're going to get massive selling. People are going to come, just like I said, that when the government creates a program, everybody tries to qualify. Oh, we have, whatever it is. Whenever they have a welfare program, it always costs a lot more money than they think because people who weren't qualified when the program was passed all of a sudden become qualified because people want the free money. And so they make sure they qualify for it. And they change their circumstances or they lie to qualify. Well, now that everybody knows that the Fed is there to buy an unlimited amount of dollars and treasuries and mortgage-backed securities and corporate bonds, and if you're sitting on a bunch of them, and there's an artificial bid because obviously the Fed is going to overpay for any assets it buys, right? That's why it's buying them, right? Because if the Fed was going to let the market dictate the price, it wouldn't have to buy. But if the Fed wasn't there and all the people who want to dump their treasuries and mortgage-backed securities, if they did it in the market price would be really, really low. So the government, the Federal Reserve is saying, we will overpay for your treasuries. We will overpay for your mortgage-backed securities, right? Well, what kind of fool would not say, okay, take mine? I mean, why would you not do it? And you're even a bigger fool if you don't, because now the question is, when is the bid going to collapse? When is the dollar going to collapse? That's when the milkshake theory is going to prove that it's all wet. All right. Anyway, next question. Anyway, inflation is not what you think will be due to the entire world going through the same thing. Yes, because all of the countries are making the same policy mistakes as America, the whole world will suffer higher inflation, and it's taking longer, but it will be worse globally. But also, because other countries are debasing their currency, it is delaying the consequences for America. If America was the only country pursuing these reckless policies, we would have had to, face our comeuppance years ago. But because the whole world has been doing this, and they're doing it because the U.S. is the reserve currency, and countries are worried about the reserve currency collapsing. And so they're trying to prop it up. And each individual country doesn't want its currency to get too strong against the dollar. So they fight this insane currency war to try to weaken their currencies, to try to prevent the dollar from falling against the currency. But it's like, this is it. This is the end of it. I mean, we're down at negative rates now, too. Look at the 3-month T-bill, the 6-month T-bill. The yields are negative. I mean, this is it. We're done. This is the end of an experiment that didn't have to be run. because I could have told you how it was going to end. We're at some point in time in the future, maybe 100 years from now when we're all dead, some other group of fools is going to think they reinvented the wheel, and they're going to think we no longer need gold, and we'll go to some fiat system, and then we'll repeat the whole process. But hopefully the world will at least have a long period of prosperity if we ultimately return to sound money, which is not Bitcoin, by the way, which is gold, real money, not fool's gold. I don't care if we transact in real money digitally. That's fine. We can exchange gold with one another digitally. We can have digital custodians, and we can transact digitally. The important thing is that the transactions are based on real money, right? Which is gold, not based on nothing. We already have that problem with the fiat. Hey, Peter, do you recommend, if we're emotionally honest with ourselves, leaving the United States for a safer haven? Look, I'm here. I just went to Puerto Rico. It's still the United States. But yeah, there are safer havens out there, unfortunately. I do think things are going to get pretty bad. I think there's going to be civil unrest. I think there's going to be price controls, capital controls, looting, riots, rolling blackouts, you name it. We're going to live through it. I mean, it's going to look like a bad movie in the United States, worse than it looks now. I mean, right now you look at the streets and they're empty, right? People are civil. Streets. Imagine when they're crowded with foreign stocks and currencies all perform. Is Canada, look, yeah. So the stocks we own in Canada are generally resource stocks, some oil, mostly gold, and I think Canada is going to have a booming mining industry up there. But look, the Canadian dollar has been getting beat up. I mean, even worse than the US dollar. I mean, gold is at an all-time record high in terms of Canadian dollar. So Canadians need to hedge too. They need to invest outside of Canada. I don't think the Canadian dollar will get hit as bad as the US dollar, but it's going to get hit relative to gold and some other countries that are in better shape than Canada. So yeah, and we're not registered yet in Canada. We're in the process. If you're interested, you can still contact Europe Pacific Asset Management, EuropaCificFunds.com. As soon as we're in Canada, we'll follow up with a call, and eventually my mutual funds will be up on Canadian platforms. In the meantime, Americans could buy my funds, Schwab, Fidelity, E-Trade, anywhere. You can go directly to Europe Pacific Funds website, EuropaCificFunds.com. Download a prospectus, read it, understand the risks. If they're suitable, you can invest directly. Don't need a broker. Just go online, buy my funds. If you have more money and you want to work with one of my brokers, then talk to one of the brokers at Europe Pacific Capital at Europac.com, and they'll help you pick a fund that's suitable for you and make sure that you understand the risks before you invest in any of my funds, my gold fund. Peter, what do you think about bank international settlement and the theory that the global central banks collapse the economy on purpose? I don't think they're smart enough to do it on purpose. I think if they tried to collapse the economy, the opposite might happen. So I think it's happening by accident. I just don't give them enough credit to think that they can intentionally do it. Hey, Peter, when people say you have 10% in gold, what does that mean? When I talk about people having 10% in gold, I'm talking about 10% of a portfolio. Not necessarily 10% of your net worth that you might include, like your house and stuff like that. But let's say after you have your house or whatever, let's say silver coins. That's it. That's all I'm talking about. 5 to 10% of an investable portfolio in gold and silver coins. It's not a lot. You don't need a lot. I mean, if gold goes up 10-fold, 20-fold, that little bit of gold and silver is worth more than the entire portfolio. And if you have 5 to 10% of your money in gold, then you have 5 to 10% more than most people. Most people have no money in gold and silver. If they even have a portfolio, it has no gold and silver. Now, I'm pretty sure that 10 years from now, most people will have gold and silver in their portfolio. In fact, it might be all they have in their portfolio. But before that happens, get yours. And again, Schiff Gold, you bet the Perth Mint at Europe Pacific Capital. Now, gold stocks are a different story. That's part of a stock portfolio, and it's much more speculative. I don't look at gold stocks as a safe haven, long-term store of value, the way I look at physical gold and silver. And silver more so, a little bit more speculative, because you got the industrial material angle. Gold is really a pure monetary metal as far as I'm concerned. Even though it has industrial uses and jewelry uses, I really look at it as a precious metal that's a monetary asset that central banks are holding and continuing to buy around the world, preparing for the post-dollar monetary era where dollar is no longer the reserve. We go back to gold, which was the reserve before the dollar and will be the reserve after the dollar. But gold stocks are more speculative. But I think that for people who are willing to speculate, the 10 baggers, the 20, the 50 baggers, right, where people are going to make a ton of money is going to be in the gold mining sector. Now, they're also going to lose a ton of money Not because I don't think gold's going to go up, but because not all gold stocks actually have gold. That's the problem. So that's why I think you hire an expert. That's why I think, instead of trying to pick your own gold stocks, you let Adrian Day do it and you buy my gold fund. So you can, buy it, through, or we have separately managed accounts, individual accounts in gold stocks. So talk it over with my brokers at Your Percent Capital on an individual basis so they can assess, the suitability of my funds for your particular risk tolerance and investment goals. Your funds have several Canadian dollar stocks. Are you concerned? Again, the only Canadian dollar stocks really we have an oil, a little bit of oil, not much, and mostly mining. And I'm not concerned about the mining stocks. I mean, I'm buying the mining stocks because I'm concerned about everything else. That's why I'm buying the mining stocks. And because I think they're cheap, because not enough people are concerned about what they should be concerned about. I mean, people are concerned about the coronavirus now. I'm not saying they shouldn't be, but they're completely oblivious to the financial and economic crisis that's around the corner. And I'm not talking about the crisis that's the result of everybody, staying home and not going to work because they don't want to spread the coronavirus or catch it. I'm talking about the man-made crisis, not the natural crisis, not something that's an act of God, but what's an act of man. It's because we were so ill-prepared for this crisis, because of all the mistakes that we made in 2008 that set us up and made us so vulnerable. And now the even bigger mistakes we're making now that are taking a nation that was teetering on the brink of disaster and just giving it that final shove to fall into the disaster. Mark just gives me 100 Hong Kong dollars. Happy birthday. Thanks. My 401k. Yep. Better than being in stocks, but that's just for now. As I said, the biggest losses are going to be the people who are in cash. People are in T-bills. Oh, the market's already closed. Look at how much time this is. I didn't realize we were after 4 o'clock. Dow ended up down 582 points. That's 3%. But they sold off the gold stocks into the close. So the GDXJ only up 6.7, or GDXJ up almost 10. But let's look how some of the individual larger mining stocks were. Newmont up 2.7, not much move there. Barrick Gold up 6.7, a bigger move there. Let me see, Yamana as a mid cap, that's up 9%. All these stocks are way off their highs. Goldfields, South Africa, up 15% on the day, so a bigger move. Kinross was up 9.5%. All these are good moves, but they all sold off on the close, which is pretty common. I mean, I watch the gold stocks quite a bit, and I still think there's a lot of selling on the close. And that's because a lot of the buying in the gold stocks is day traders, right? There's still no real money that has moved into this sector. You get some day traders that get long in the morning, they ride the rally up a little bit, and they want to close out their positions. They're trading on margin. They don't really have enough money. So this is all a bunch of noise right now. When the real money, when the institutional money starts moving into these stocks, when they finally figure out what I've known for years, and everybody decides that they need to have some gold stocks in their portfolio, these things are going to explode, right? If I'm right. I mean, they're not going to just go up 9 or 10%. I think we're going to see some days where you see 30, 40, 50% moves in big gold stocks because some big brokerage firm put out a buy recommendation on one of them. Oh, everybody needs to buy this. Nobody owns these stocks right now. See, once the institutions think it's safe to buy, once buying gold stocks becomes the conventional wisdom, then everybody's going to do it. See, right now, it's like, I don't want to go out on a limb and buy gold stocks because nobody else is doing it. And if I buy a gold stock and it goes down, then they're going to say, why'd you buy this idiotic gold stock? What are you, some kind of kook? What are you, like a Peter Schiff? You're fired. Get out of here, right? But if everybody else buys a gold stock and you buy it and it goes down, well, you're covered, right? Because you just did what everybody else does. If everybody else starts buying a gold stock and they all go up and then you don't buy one, and then your shareholders meet with you, what are you, an idiot? Why didn't you have a gold stock? Everybody else bought a gold stock. What are you, some kind of moron? You're fired. So once everybody buys them, then everybody wants them. And of course, by that happens, the price goes through the roof. I don't want my clients waiting for everybody else to buy. I want to buy before the herd, not with the herd or after the herd. Let me see how many more questions I have because it's already past the time I wanted to stop. All right. I mean, when did I start at 1? Yeah. So, all right, I'll go till 5. That'll be 4 hours. Can I get a little bit more water? as I said, these are like telethons, like the Jerry Lewis telethon, except I'm not on my feet the whole time. But you see me, I squirm around on my seat because my butt gets sore just sitting in this chair for all this time. I got to like take some of the pressure off by getting up a little bit. But I'm sure I know I'm going to have a lot of calls to make because I'm getting a lot of messages and stuff. I got voicemails on my phone. So when I finish this, I'm not done working. I got stuff to do because, I've spent 4 hours doing this podcast video and now I got extra work. My birthday is, I'm going to be working my ass off on my birthday here. Let me see. Hey, Peter, U.S. experiment with MMT. Yep. Modern monetary theory. Yep. Nothing modern about it. It's really not monetary, and it's not a theory because a theory you have to have the, presume it is viable. Now, it could look viable in the short run. Yeah. And that's what makes people think it could actually work. But it's all an illusion. It doesn't work. It just makes problem bigger, but they're hidden from view. But then when they blow up, you have to find something like the coronavirus to blame it on. Eric, what will trigger the loss of confidence in the dollar? It's going to be just a loss of value. At some point, prices will be rising fast enough that people will lose confidence. And it all is a confidence game. It's a con game. That's the only thing that really backs up the dollar, is confidence in its future purchasing power. And once the confidence is lost, there's really no way to restore it. It's a death spiral. And I think, unfortunately, the dollar is going to die. And the only way to resurrect it will be if it's backed by gold again. That'll be it. And the dollar initially is defined as a weight of gold. That's what a dollar was. It's a measure of gold. The dollar actually describes a measure of gold, how much gold you have. So the dollar is a weight of gold. That's what it is. We turned it into just a piece of paper, but that's not what it's supposed to be. But that's what it needs to be again. Love your podcast, Peter. This is love your podcast. Do you think wages will rise anywhere near fast enough to keep pace with hyperinflation? Not a chance. All prices will rise in hyperinflation, including the price of labor, wages. But a lot of people are going to lose their jobs in hyperinflation, so their wages will be zero. And their unemployment checks will not rise nearly as fast as inflation. But even people who have jobs, wages will lag the cost of goods. So everybody is going to be impoverished through inflation. The stocks will go up more than the price of gold, right? I think a lot of the foreign stocks that I have could go up more than gold. And I think they'll deliver good dividends that you can live on. So this is what we're doing. I'm building portfolios that I think will outpace inflation because there's no way your wages will or any of your government benefits. Paul, can you bring me water? I really need some more. All right, let's drop. Happy birthday, Peter. I heard you mention that you would be hiring your asset management in Puerto Rico. Yeah, there's nothing on the website about it. You just got to send an email if you're in Puerto Rico or you're thinking about moving to Puerto Rico. It's really good if you're in the business, you have a license or something. But you can email Paul at schiffradio.com. But yeah, we don't have anything on the website because we're not. I don't know how many people we're going to hire. We'll see. But we're not even in Canada. But I can still use a couple of people. But I'm talking to a couple of people right now, so I'm not really sure. But obviously, over time, we'll be hiring people. So it can't hurt to send us your information. Could we be on the path to a guaranteed basic income? Yeah, we might have the guaranteed basic income. That was a campaign issue for Andrew Yang, and all of a sudden you got Republicans, Mitt Romney, who was the presidential candidate who lost to Obama. He's advocating some kind of basic income. I don't know if it's a permanent thing or just a coronavirus emergency. But look, the problem at some point is going to be the checks aren't going to buy anything. What good is it if you have a basic income if your basic income doesn't buy you anything? That's the problem. Now, there are other problems with it, but that's the biggest. If we're going to have hyperinflation, none of this is going to matter. Your income isn't going to matter. It's what you can buy with that income that's going to matter. Thoughts on the British economy? I had a lot of thoughts on the British economy. Don't have enough time to really address them. I think they're better off leaving the European Union. I would have been in favor of Brexit if I was over there. But what they need is less government, right? Part of the idea was they didn't want to deal with all the government in Brussels, which is good. There's too much government in Brussels, but there's too much government, from down at 10 Downing Street or from Parliament. I mean, it's not that the British needs less government from Brussels. They need less government there in London. They need a smaller government. And so they need more freedom. They don't need bailouts and stimulus and artificially low interest rate and inflation. I mean, the Bank of England's drunk from the same Kool-Aid. I mean, they're pursuing the same irrational monetary policies. The one good thing that's going to come out of this is at the end of this, when we have this currency crisis, all of these guys, their reputations are going to be destroyed. Their theories are going to be completely and utterly discredited. And so hopefully we'll be able to, have sound money and have a rethinking of all this. And so that maybe we'll embrace sound money again and have, the conventional wisdom actually be wise instead of completely idiotic, which is what it's degenerated to. What books or chapters have been most insightful? Look, I don't know. I read, as a kid, I read Rothbard, and I said I read Hazlitt. I read Ayn Rand. I read Austrian free market thinkers, libertarian, older philosophers, and I had my dad. I read my dad's book, The Biggest Con. And, the book that I turned into a book with my brother, How an Economy Grows and Why It Crashes. His was How an Economy Grows and Why It Doesn't. Kingdom of Malts, my dad. We still have copies. I mean, I don't know how many we have left, but you can go to my website, schiffbooks.com, and get I still have some copies of The Kingdom of Malts that my dad wrote. I don't have any copies anymore of The Biggest Con. You can find a few on eBay or Amazon. I don't have any to sell. I have a few, but I'm not selling them. I want to keep them. But I still have a few of The Kingdom of Malts left. And we have our own books, I think, or you can go on Amazon and order my books, Crash Proof. Crash Proof 2.0 is the more recent one. Get that one. The Real Crash, the revised edition. You can get that on Amazon, or I think I have a link to that through schiffbooks.com. And then if you're going to get How an Economy Grows and Why It Crashes, try to get the collector's edition if you can. If not, just the regular edition is a little cheaper. But I think they're all kind of discounted now on the online booksellers because they're older. They're several years old now, but they're very, very valid. They're in fact they're probably more relevant now than they were years ago. Agree the U.S. dollar will decline, but where will foreigners end up parking their cash? Yeah, well, they'll get out of dollars either into other currencies that they think are less bad, or in gold, in silver. A lot of the cash isn't going to be parked. It's going to be lost because when the dollar crashes, a lot of wealth is going to evaporate with it. So people will lose that. But what they're able to get out before the music, also my computer froze up. All right. If they get out before the music stops, and they'll put some into stocks, into equities, into other assets, into real estate, whatever. But I mean, a lot of money just disappears. If you were in your 30s and had $500,000 that you can get with a couple of weeks, what would you do with it? I would send it to me. I would open up an account at Euro Pacific Capital and invest that $500,000. I would talk to one of my representatives and get a plan. Like, let them know all of your particulars, all of your your goals and your objectives and things like that. And help. And I can manage that portfolio. If my strategy is suitable for you and my representative, we can determine that suitability, then get invested, and you can talk with him about which type of strategy. A separately managed account, a wrap account, certain funds, brokerage, app managed, whatever. But go to Europac.com and call the 800 number, or just fill out a form to have a broker get a hold of you. And congratulations for being in your 30s and having any money. I mean, most Americans are broke. They don't have $500, let alone 500,000. So that's good. But what you need to do is preserve the purchasing power of that 500,000, because one day $500,000 may mean nothing, right? It may be just pocket change. So before that happens, preserve it by spending it now, not spending it on consumer goods that will depreciate, but acquire real assets that will hold their value, potentially appreciate, and pay dividends. If you were 22 in Canada, had about 200,000, what would you do? Again, is that California? No, I think that's California. Yeah. No, Canada. Well, send it to me if I could. I'll be in Canada soon. Just let my representative know that you're a Canadian. In the meantime, you can buy some physical gold up there or something. Send an email to us. Go to Euro Pacific Europe Pacific Assets or EuroPacificFunds.com. Anyway, I'm out of questions. Oh, well, that's a good thing. Anyway, since I got to all the questions, I think I'm just going to end the podcast. I'm out of questions, right? Because there's nothing left for me to read.
Yeah.
All right. So I'm going to end it. I'll cut it a little short, so I won't go the full 4 hours. But as I said, there's a lot of good stuff in here. Hopefully, people can actually sit through and listen to the entirety of it, because I answered questions, but all throughout, I interjected a lot of important stuff, which, maybe we can even grab some of that important stuff and piece it together and make a shorter video out of that, so that maybe people, that can't, sit through 3.5 hours. But I know people listen to the Joe Rogan's podcast. It's 3 hours, sometimes closer to 4 hours. So yeah, especially now, when a lot of people don't have anything else to do. And again, the airwaves are filled with a bunch of nonsense. The news, financial and regular news, everything is wrong. All the opinions are wrong. Maybe, once in a while a guy like Jeff Gundlach comes on and says some things that are right. But even he sugarcoats it a lot. He may be, dumbing it down for the audience. Maybe he's afraid to say some of the stuff that I'm saying. Although I don't think he's quite as bearish as me. But I think he's probably closer to me than the mainstream. That's how ridiculous the mainstream is. But most of the people that come on, just complete nonsense. They're just talking to bail themselves out. They're trying to save their own butts from mistakes that they made, and they need these government bailouts. And they're trying to pretend that it's for the country, or maybe some of them actually think it's for the country. Again, a lot of these guys don't know, right? They're drunk on the same Kool-Aid as everybody else. They actually think that bailing them out actually bails out the country. They don't understand how capitalism works. Which is very frustrating, because you have some of the most successful people in capitalism, people who have made billions, right, in at least a somewhat capitalist economy, having absolutely no understanding at all of the system that helped make them rich. Now, the problem is a lot of the guys on Wall Street, the hedge fund guys, they didn't get rich because of capitalism. They got rich because the central banks polluted and destroyed capitalism. And as they did that, as they siphoned all the capital out of Main Street, they enriched a lot of these speculators on Wall Street. So it's no wonder that they don't understand the problem, right? Because they got rich off the problem. So they don't want the problem solved. They want the problem perpetuated. Bye for now. And again, thanks everybody for contributing and for wishing me a happy 57th birthday. Bye-bye.
Who's left to buy? Nobody. Everybody's already bought. You just got a bunch of people who are looking to profit from the halving who want to sell. And in fact, as I expected, as I said on my last podcast, that they may not have bought the rumor, sell the fact. They might have sold on the rumor of the fact. And that's exactly what they did, because even though the halving didn't happen until today, Tuesday, the real break, I think, in Bitcoin was on over the weekend, was a Saturday or Sunday. And all of a sudden, Bitcoin in about, 5 minutes fell almost 2,000. It went from about 10,000 down to almost 8,000 in just 5 minutes, 10 minutes, collapsed. It immediately bounced back to around 9,000. As I'm recording this now, it's 88 and change. But we got that big sell-off leading up to the halving. And of course, by the time the halving happened today, it was a yawn. It had no impact on the price. But we did get a big sell-off leading up to the halving, because I think the people who were speculating were worried if they waited for the halving itself, the price might have dropped. And so they front ran the halving, and they decided to sell in advance, which is something I thought might have happened. And I talked about it on the last podcast, and that's exactly what did happen. But now I think you still have a lot of guys who bought in front of the halving, who were intending on selling at a higher price after the halving, and may have to settle for whatever price they can get. I think a lot of disappointed Bitcoin speculators are going to be selling, and there's another leg down. That initial 2,000 point dollar drop was the beginning of a bigger move. We barely got above 10,000. We got to like 10,100. There's so much resistance up there. Even with all the hype of the halving, we couldn't even really sustain a move above 10,000 going into the halving. We got that big sell-off. Now, we did get yesterday the Paul Tudor Jones interview on CNBC, which I said I thought was another catalyst to make Bitcoin go up, and that maybe if he was not positive on Bitcoin, it would end up being a negative. And what happened was the Bitcoin rallied sharply. It started a few hours before Tudor Jones was going to be on CNBC. And I watched the rally. It was a sharp rally. And as soon as Paul Tudor Jones started to talk, that's when the rally peaked. The absolute price of Bitcoin, it was over 9,000. Forget where it was, 91, 9,200. But it peaked just in the middle or as he started to talk. And it sold off as he was talking. And by the time he finished, about half the gain had been gone. So it was clear that a lot of Bitcoin people were trying to trade Paul Tudor Jones. They knew he was going to come on. They expected him to talk positively about Bitcoin. And so they wanted to use it as a trading opportunity to buy the rumor of John Paul Tudor Jones and sell the fact as he spoke. And that's exactly what happened. And you can actually see that trade play out in real time, just perfectly. But I think it really was just, a symbol of what's happening on a broader scale with the halving. It's a much bigger buy the rumor, sell the fact. And so it's not playing out in as short a time span. It will take place over a longer period of time. But just to talk a little bit about what Paul Tudor Jones said, because he didn't give a glowing endorsement of Bitcoin by any means. He did admit that he thinks he has 1% of his portfolio in Bitcoin, and he thinks it could be a little more, that it's no more than 2%. It might only be 1%, but he's not really sure, right? He didn't know exactly. But clearly, if he's only putting 1% to 2% of his portfolio in it, he regards it as extremely speculative, right? I don't know what percent of Paul Tudor Jones' portfolio is gold, but I'd be willing to bet it's at least 10 times as high as his Bitcoin allocation. And I think the reason that he's keeping the allocation so low is because he realizes there's very good probability that Bitcoin's going down and he's going to end up losing money on that position. And so he wants to lose money on a small position because you could overcome that. Now, he did leave the window open, the possibility that Bitcoin could be his best performing asset, that in this environment of massive inflation and money printing, that Bitcoin really could take off. And since he's so confident there's going to be inflation and a rush into gold, and I agree with him on that, he just thinks that Bitcoin might be the fastest horse in the race. And so why not bet a little money on gold, on Bitcoin? Because if gold goes up because of inflation, maybe Bitcoin will go up a whole lot more. So let me throw 1% of my portfolio into Bitcoin just in case. And that's, I think, the position he took, which is not a big position, because after all, most of the people who own Bitcoin today, the vast majority, probably have a lot more than 1% of their net worth in Bitcoin. I mean, I would say that most of these Bitcoin fanatics, their entire net worth, it could be in Bitcoin. I know that guy, Anthony Pompliano, I get into some wars with him on Twitter once in a while, otherwise known as Pomp. He's talked about the fact that half of his net worth, and I think he's got a pretty decent net worth, but half of it is in Bitcoin, right? Well, you got all these Bitcoiners that are so excited about Paul Tudor Jones saying people should buy Bitcoin. Yes, with 1% of their portfolio. So if you've got 50% of your portfolio in Bitcoin, you're not following Paul advice, Paul Tudor Jones advice. Can you imagine if all the Bitcoin holders decided to follow Tudor Jones advice? Right? Imagine, right? They'd have to sell 90% of their Bitcoin, right? There would be a crash in the Bitcoin market. If everybody who owns Bitcoin went to follow that advice, the market would crash. Now, I know people are going to say, well, but what if everybody else in the world just decides to follow Tudor Jones and put 1% of their net worth in? If that happens, then, well, I'm going to make a fortune keeping half of my net worth in there, which is true. But the odds of that actually happening are very slim. That's why that's a 1% allocation. Because if you lose 1% of your portfolio and you're a good trader and you're making money on other things, and I'm sure Jones is going to make a lot of money on his gold positions, whatever they may be, and maybe he's got some gold stocks. I think he'll make so much money there. blowing 1% on a Bitcoin gamble is going to be no big deal. But if you've got half your net worth in Bitcoin and you lose that, you may not recover, especially if you're one of these Bitcoiners that thinks gold is obsolete now and you own no gold, you own no silver, you've gone all in on Bitcoin. There's no way that Jones is going to do something like that, right? He's absolutely. So to say that, hey, this is the reason you should buy Bitcoin because now a hedge fund manager who is speculating on inflation. First of all, Paul Tudor Jones is in the minority, right, of people who are looking for stagflation, right, that kind of agree with me, right? There's a handful of us out there in the economics, and there's some people, you got Ray Dalio who says a lot of the same things that I do. So there's other big fund managers that are seeing stagflation, but there's not that many that even are worried about it. And if most of the people who aren't even worried about inflation now and who see no reason to get out of the dollar, if they become worried about inflation for the first time and they really want to seek out, exposure, a hedge, something like gold, what's the odds, right, that are they going to go for gold or are they going to go for Bitcoin? If they don't own anything right now and they're managing institutional money, they're conservative by nature, they move slowly, and all of a sudden for the first time, they're worried and they want to hedge. Are they going to pick something like gold that has real intrinsic value, that's been a store of value for thousands of years, or a cryptocurrency that's 10 years old and they have no idea what it's ever going to be worth because it has no current intrinsic value? Are they going to gamble on Bitcoin or are they going to play it safe with gold, right? Obviously, gold is their next move. I mean, Jones already has a bunch of gold. He already has probably a bunch of gold stocks. All right, I'm going to take a flyer on Bitcoin. And who knows how long he's going to be in this Bitcoin position. Once this thing really starts to fall, he might cut his losses. He might get out when he's down 20, 30%. He may not ride the thing all the way down to zero. So who knows how long he's going to be there. But just because he may have a position now, this is not some big endorsement. This is one guy who's in the fringe kind of the hedge fund world acknowledging that he's doing something extremely speculative by taking a flyer on Bitcoin, but he has a feeling that it's going to work out because he thinks that we're going to have all this inflation and gold's going to go up, and so people are going to be looking for inflation hedges. I think he's wrong. And I heard people tell me, hey, Peter, look, it's just 1%. Why don't you put 1% of your net worth in Bitcoin? And, I'd rather put another 1% in junior mining stocks. I mean, if I'm going to take a big gamble, because that's what Paul Tudor Jones said. He thought that the upside in Bitcoin was greater than the upside in gold. So he thought there was more potential. Now, I don't think he appreciates the downside risk. I mean, he does. But I think if you weigh the upside potential relative to the risk, I don't think Bitcoin is a better risk-reward dynamic. Now, maybe if you think the upside potential is 1 million or something crazy like that, then you may come to that conclusion. I just don't think there's that much upside relative to all the downside. Yes, could Bitcoin end up going up more than gold for a period of time? It could, but I don't think it's worth the gamble that it might, when I think the odds are that it won't. But getting back to these, the mainstream guys, so are they going to take a chance? I mean, even Jones admitted on the CNBC interview that gold has a long history and a long track record, and it's proven. And Bitcoin is the new kid on the block. It's very risky. It's unproven. And so even the guy that owns both, right, has very different views of gold versus Bitcoin. One is a conservative store of value, and one is a flyer, right, that he's taking a shot on. As more people in the mainstream finally decide that they got a hedge and there's inflation, they're going to choose gold. They're not going to go from nothing to Bitcoin, right? They're going to go to gold before they potentially take a shot at Bitcoin, and then only with a small amount of money. But of course, if Bitcoin has already collapsed by then far fewer investors are going to be pressured to go in it. Because I think right now, when people see the big gains, hey, why did you miss out on that? Why didn't you get in? But once Bitcoin really starts to fall, then it's the people who got in that feel like idiots, and the people who avoided it can look like the heroes because they didn't fall for it. And that's when you get the real big PR problem for Bitcoin, right? When you have all these horror stories, not a bunch of get-rich stories where high school kids took their bar mitzvah money and became millionaires because they bought Bitcoin. Then you're going to hear stories about people who went broke buying Bitcoin because they invested a lot more than bar mitzvah money, right? They took their house money, they borrowed money and bought in at Bitcoin at a much, much higher price. They got in at the end of the bubble, or as the bubble was deflating, rather than early on, right before much air even got into it. And so once Bitcoin has that really negative PR problem, it can't shake it, and then that's it. Then the party is over. But anyway, we're again 8,800 and change now. We'll see what happens tomorrow. Ben Bernanke is talking, so the markets are probably not Ben. Tomorrow, Jay Powell is talking. We had a few other Fed guys out today, but of course, none of them have the status as the chairman himself. So the markets are really going to be looking to what he has to say, potentially about negative rates. I am still looking for a big break in the dollar. I haven't had it yet. Still looking for a big move up in the price of gold. I think it's getting ready to happen. Hasn't happened yet, but I think it is going to happen any day. But anyway, I will be back again with another one or two podcasts later in the week as the markets develop. Again, we went off on a very, very weak note for the stock market. So I think we could be in for some interesting action in all the markets in the days and weeks ahead. Bye-bye. Thought that, it would be bad if they didn't raise the debt ceiling. No, it's bad if they do. And again, this should be good for gold. Raising the debt ceiling means more debt, more inflation. That is positive for gold. Gold has had a pullback recently. I'll get to that a little bit later in the podcast. But all of this should be bullish for gold and bearish for the dollar. Another piece of economic news that we got last week, again, real bad. I mean, almost all the news was worse than expected. I'm just focusing on a couple of ones that were particularly problematic late last week. The Chicago PMI, right? That was supposed to be 47. It came out at 40.4. Actually, no, that is today's data. That number came out today. I jumped ahead of myself. Hold on, I got my slides mixed up here. The Richmond Fed manufacturing. Let me talk about that one first because that was last week. That was supposed to improve from minus 10 in April to minus 8 in May. And instead of improving, it got worse. It went to minus 15. So it was already bad at minus 10. And then it came out to minus 15. Now we know we're not manufacturing because that's one of the reasons that our trade deficit went up. That's one of the reasons our exports went down because we can't export stuff that we don't make. And if we're not making stuff, well, that's going to be reflected in these weak manufacturing numbers. And that is exactly what's happening. The other data point I wanted to talk about from last week that came out on Friday, which was one that the markets did pay attention to, unlike the trade deficit, which, they completely ignored. And that's the personal income and spending numbers. And the income number was pretty much in line. It was up 0.4. But the spending was up double estimates. They were looking for up 0.4, and we got up 0.8. Now, why are Americans spending so much more money? Well, obviously, it's because stuff costs more money. That's the real reason that spending is going up, because prices are going up because of inflation. And in fact, even in the data, the PCE, and apparently, this is the Fed's favorite way to measure inflation. And that's because it's the least accurate, right? It's the lowest number because it has the most substitution and hedonics and, sleight of hand. That's why the Fed likes it, because it puts the best possible spin on inflation. But even those numbers, they were looking for the month over month PCE to go up by 0.3. It went up by 0.4. But more important, the prior month in March, it was only up by 0.1. So we went from 0.1 in March to 0.4 in April. Despite the rate hikes, these numbers are going in the wrong direction. The same thing for the core. The core PCE was supposed to go up 0.3. It went up 0.4 versus 0.3 in the prior month. And look at the year over year numbers. Last month, the year-over-year increase in the PCE was 4.2. Now it's 4.4. Higher than the 4.3 expected, but more important, above the 4.2, going in the wrong direction. And if you take the core year over year, stripping out food and energy, again, 4.7 for April. It was 4.6 in March, going in the wrong direction. Inflation numbers are getting higher, not lower. So how has the Fed made progress? How are we moving inflation towards 2% when it's moving in the opposite direction right now? And rates are already at 5.25%, and we're potentially going to get another rate hike in a couple of weeks during the June meeting, when rates are going to be, what, 5.5%, 5.75%, right? Adding to the inflationary pressures that are already in the economy, because we are increasing the interest expense that everybody has to pay on the enormity of debt that already exists. Now, I want to get to the data from this week. I just started with the Chicago PMI. I already kind of let the cat out of the bag on that one, because I read it off. But again, I'll say it again. That came out earlier today, and it was a horrific number. This is like the worst Chicago PMI since the financial crisis. It was supposed to be 47, a little bit down from the 48.6 in April. And it plunged to 40.4. I mean, the low end of the range was 44.5, and we're a full 10% below that number. This is a horrific number for the Chicago PMI. And of course, we've been down, I forget, something like 13 or so months in a row. So we've been in recession for a long time, according to this number, and it's actually getting worse. Now, when this number came out initially, there was a sharp rise in the price of gold, about $10, $12 immediately. Gold spiked when this number came out, because this is bad news on the economy. But then about 15 minutes later, we got the JOLTS report, and then gold lost almost the entire rally. Didn't quite go negative. It went, from up like $10, $12 to up maybe $2 or $3. As soon as this JOLTS number came out, which kind of boggles the mind, because the JOLTS number showed a huge increase in the number of jobs, openings, over 10 million. It was 9.59 million in March. And that was revised up to 9.745 million. And the consensus for April was for a drop to 9.35. I mean, why did people think this? Well, people are losing their jobs. All these layoffs are being announced. People are, losing their jobs. And now you have all, people implementing or starting to implement AI, and you're getting some job losses there, but you have job losses in the banks and the financials, and a lot of these companies, money-losing companies, are having to cut their burn because they don't have access to capital. So people expected the number to come down. Instead, it went way up, which makes no sense. I don't even believe these numbers. One thing in this is they give you the so-called quits rate, which lets you know how many people are quitting their jobs, and that went way down. And so that doesn't show a strong economy, because normally, you don't quit your job unless you think it's easy to get a better job. So in a strong job market, people are likely to quit, right? But if the job market is weak, you're kind of going to stay put. You don't want to take your chances in the labor market, because you may not get something as good as the job you have. And so the fact that the quits rates are going down would suggest that the labor market is not really as robust as this JOLTS report would suggest. But this is the only really strong number that we've had in the last week and a half. I mean, we've had a couple of numbers that might have been slightly in line or a little bit better, but not like that. But most of the numbers have been like the Chicago PMI, maybe not quite as bad as this one, but they've been worse than expected, and they're all flashing recession as the Fed is hiking rates and as inflation continues to get worse. But meanwhile, the markets in the month of May have been oblivious to all that, right? They're not paying attention to any of the stuff that's really going on. Nobody sold in May and went away, unless you're talking about people who own gold stocks. But May was a huge month for the stock market, particularly the NASDAQ. I want to go over that. So the month of May, which ended today, this was the last
day of the month. And the NASDAQ was up 6% in May, 6%. And if you look at the NASDAQ 100, right, the QQQ is the ETF for the NASDAQ 100, the biggest NASDAQ stocks, that was up 8% in the month. That's it. I mean, it's a huge number, led by NVIDIA, right? NVIDIA was the biggest gainer. It was up 36.5%. And that was with like a 5% decline. I think it was down today by that much. I'm going to take a quick look at it. 5.6% on the day. But even with that decline, you still had like 36.5% increase on the month. And you had other stocks, Google, Meta, a lot of these big stocks that are perceived to be the main beneficiaries, the initial beneficiaries of the AI revolution. Those stocks saw the biggest inflows and the biggest gains during the month of May. Now, if you take those stocks out of the game, there really wasn't much going on. In fact, the S&P 500 was only up about 1/3% during the month. All of those gains attributed to the big tech stocks that are part of the S&P 500. If you look at the Russell 2000, which doesn't have all these tech stocks, it was down 1%. The Dow was down 3.5%. They've got more charges trumped up against Trump for January 6th. Meanwhile, they completely ignore what's going on with Hunter Biden and the big guy. I mean, look at the newest revelation, new documents that were just released, I think, yesterday, just confirming that the Bidens were paid this $10 million bribe, $5 million to Hunter and $5 million to the big guy, Joe Biden, in order to apply political pressure, right, in the Ukraine to help this Ukrainian oil company solve a problem. They were able to pay off the Bidens, and in the documents that were released, they're even referencing the fact that, well, Biden is not really that smart, or Hunter, we got to keep him on the payroll anyway, but we got to find somebody who actually understands something about oil and gas, because these guys don't know anything, but we need to keep them on, and Hunter is going to take care of this problem through his dad. We've got this problem and we have to pay off these guys, but don't worry, because Biden is going to take care of it. I mean, these are serious crimes, and it seems like there's plenty of evidence to at least bring charges. Now, there's probably enough evidence for a conviction, but there's certainly enough evidence to file charges, yet nothing is happening, right? All we're focusing on another indictment for Donald Trump, and we're ignoring the fact that we have a sitting U.S. president that has basically committed acts of treason while he was vice president, and who knows what he's done while he was president. But again, getting back to the particular hearing, it's very obvious from all of the stuff that has come out that the Biden campaign was able to convince social media, Twitter, Facebook, to bury the Hunter Biden story of the laptop by labeling it fake news, by claiming it was some kind of Russian propaganda to influence the election. And so they got social media to bury the story. And it's pretty apparent that had that not happened, had the story been told, had people been allowed to share the story, and it really started with the New York Post, right? But had that story been allowed to organically grow, had there been appropriate media coverage of what was revealed in the Hunter Biden laptop, it's very likely that the results of the 2020 election would have been different, that Donald Trump would have been reelected had the media fairly covered the election. So everybody wants to talk about the fact that, Trump was talking about the election was rigged, the election was unfair. Forget about all that, whether the votes were rigged or not. It was rigged in the media.
it was rigged by a collusion between the Biden camp and the media to deceive the voters, to not allowing the voters to hear a story that would have been detrimental to the Biden campaign. That is the real story, I think, of the 2020 election. Forget about what might happen at the polls, right? It was that effort, because the election, I mean, it swung on a few states, right? But 4 or 5 states that could have gone either way, right? That's how Trump won. The states that he won could have gone the other way. They were pretty close. And then he lost those, states. But had the news been allowed to spread, it's very likely that Trump would have won. So he obviously had a right to be pissed off about the coverage and about having been falsely accused. But now they're trying to accuse him again of another crime because he is protesting the election. And again, just like with freedom of speech, you've got to be able to protest an election. I mean, you can't say that if you believe an election wasn't fair, that you can't say anything about it. You have to be able to say something. In fact, elections have been contested ever since we've had an election. How many people demand a recount, right? And it happens all the time that people contest elections. Elections have to be contested, because if I'm holding an election and I know that it's beyond contesting, well, then why not cheat? Why not rig it? If I never have to worry about being challenged, if it's somehow illegal to question the results, well, then how do you know the elections are fair? You have to have some accountability. You have to be able to withstand a challenge. And, can people protest? Right? People keep talking about, January 6th, people went down, they protested. So what? They protested. They keep wanting to call what happened on January 6th insurrection, as if they actually went down there to overthrow the government. How are you going to overthrow the government without any weapons, when all you have is cell phones and you're taking selfies? What kind of insurrection is that? And of course, they get down there and the Capitol Hill police are escorting these people into the Capitol building, opening up locked doors. Here you go. I mean, nobody thought they were doing anything wrong, at least the majority of people. But this has all been spun by the media. The same way they went after me. I talked about this again on my last podcast. The government wanted to pretend that I was using my bank to help criminals launder money and evade taxes. And how did they do that? They got the media to do their dirty work. The media went out and told the government's lie for the government. The government wasn't able to tell the lie themselves. They had the media do it. Although then, to protect the media, because, I sued for defamation, they went out and told the lie themselves when they had the press conference down in Puerto Rico. But more proof, again, that the media is colluding with the government is that, sure, the New York Times was willing to report that I was under investigation for money laundering and tax evasion. They were willing to write that story. The story that they refused to write is that the investigation found nothing, that it turns out that I wasn't guilty of money laundering and tax evasion. They don't want to write that story. As far as they're concerned, there is no story anymore. Now, of course, if I was indicted, well, it would have been all over the New York Times, right? They would have wrote that story. But the fact that they didn't find any evidence to even charge me with a crime, the story is over. And of course, they were willing to write the story about 60 Minutes and about me walking out on the interview. Oh, Peter Schiff walks out on this 60 Minutes interview as if I had something to hide. But when I sue 60 Minutes for defamation and I win, they don't want to write that story. The New York Times didn't get sued. I didn't sue the Times. And 60 Minutes Australia actually used that against me. They tried to say that I should have sued the Times. And because I didn't sue the Times, that they shouldn't be liable, which was BS. But there were reasons I didn't sue the Times. One was because the 60 Minutes stuff came out first. And had I sued the Times could have said, well, we were just relying on 60 Minutes. We relied on these other stories, and therefore we had a reasonable basis for what we said. And I thought that they could have used that. Also, it's harder to win a defamation lawsuit in the U.S. when you're a public person, because you have to prove malice. So not only would I have to prove that the statements were false, which I could have easily done. But I would have to prove that 60 Minutes was malicious, or the New York Times was malicious in their reporting. But given the fact that they could say, well, we were just using 60 Minutes as a source, I didn't think I could prove malice. And that was the advice I got from counsel. So I didn't sue them, right? But you would think, hey, I didn't sue you guys. You can at least set the record straight. You could at least say, hey, remember we wrote this article about Europe Pacific Bank and Peter Schiff, and they were under investigation. Turns out they didn't do anything wrong. But the bigger story, the one that they refused to write, is the fact that their reporting of the investigation destroyed the bank, even though it was completely innocent. Even though we didn't do anything wrong, the bank is gone. Why? Because the media killed it by prematurely reporting guilt, or just reporting the investigation. Because once you report that somebody's being investigated, well, they might as well be guilty. After all, why else would they be investigated? But this is what they did with the Hunter Biden. This is what they're doing now with Trump, what they're doing with Robert Kennedy Jr. The media is crafting a narrative, and they're working with the government to push this political agenda. All of this is obvious that this is going on. And it is very frustrating to actually be dealing with it personally, but watching the whole thing transpire. There has got to be a big backlash. That's one of the reasons that I'm hoping that I can get some type of congressional investigation of the circumstances surrounding what happened to me, because I think all this is important, because I think there's enough information here that, and especially if a congressional hearing can get a lot of these documents that I'm not able to get, that the government is able to hide, to actually show how this is working, how the government conspires with the media to deceive the public. You know, because if I can show it with me, then you could show it on a much broader spectrum. But this is exactly what's going on. So that's why these hearings, and if you haven't watched it, you know, it's, I don't know, a couple of hours, but it's worth watching. And it's interesting too, that the Democrats, to watch them, how they're attacking Robert Kennedy, and then to see the Republicans have to come to his defense. I can understand the political strategy there, but it's the irony, I think, that is most important, rather than the politics. And the fact that you do have to have some Republicans that are still standing up for freedom of speech. It used to be something that the Democrats at least claim to care about. They don't care about it at all anymore. The only speech that they want to protect is speech that they agree with. And they want to completely censor anybody who says anything with which they disagree or they find offensive. Well, that to me is extremely offensive. As an American, as a libertarian, everybody should be offended by what is currently happening. Anyway, that's it for today's podcast. I will be back home, or not home. Home is Puerto Rico. I'm not going to be back in Puerto Rico probably until about the 10th of August, which is actually coming up. So it's not that far away, but I will be back in Connecticut for the next live episode of the Peter Schiff Show podcast.
You don't get anything. You just got outbid. But you need to register in order to bid in the auction. And so you want to go to the website, and you can see, the representation of the art and obviously the ordinals on the website. So you want to go to one, it's just the number one, not ONE, but a one, marketprice.com /golden. And that is the site where you can see the image, and then you can register. Right now you can. I think starting on Friday, there'll be a registration page. So you can go to the website now and just check it out, but go back again on Friday if you want to register to bid at the auction. Now, of course, Do I think that, these things are going to appreciate? Well, I think that the artist himself, is a talented artist, and he's sold a lot of work. There are a lot of people that collect his stuff now, and he's sold them for, decent dollar amounts. So in that respect, I think the art could gain in value. But what I also think, and this is kind of like a twist, but if it turns out that I'm wrong, and Bitcoin actually turns into something that I don't believe it will, and if these ordinals end up having value in their own right, just like NFTs, which I don't think, but I think if I'm wrong, and obviously most Bitcoiners must think I'm wrong. In fact, I know they think I'm wrong. I get, crap from them every day. So they definitely think I'm wrong. They should be buying these ordinals at a minimum, if not the original painting itself with the ordinal that is attached to that, because there's only one of those, right? There's only one ordinal that goes with the oil painting. The other 50 go with the prints. But if it turns out that I was wrong, who knows what these things might be worth? Because I think I am the number one Bitcoin critic. In fact, I know I'm the number one Bitcoin critic because I asked ChatGPT. I went into ChatGPT and I said, who is the number one Bitcoin critic? And it came back and said Peter Schiff. That's what the artificial intelligence things, GPT. In fact, I asked ChatGPT, who is the world's biggest gold bug, best known gold bug? And again, it came back with Peter Schiff. So I am the biggest, most well-known gold bug and the biggest, most well-known Bitcoin critic. And so I would think that a ordinal that I created, triumphantly raising a bar of gold and declaring victory of gold over Bitcoin. And if it turns out I was wrong, right, I think this is a major thing. I think this could have a lot of value in a world where I'm wrong, right? And now here's the original big Bitcoin, denier, with his bar of gold in his hand. And look, and he was wrong, but this is what he created. It's the only thing I've ever created and put on the Bitcoin blockchain. I never, got behind any of these other coins. I've never done anything. And the only reason I'm doing this is because I think the actual prints, right, and the oil painting, yes, they have actual value, right? You could, that's there. Whether or not these ordinals add any additional value beyond the fact that they make it easier to prove that you own the print and that it's not a fraud, I don't think so. But other people disagree with me. You have all these people out there that believe that, Bitcoin is it, right? And including this artist, Market Price. He's a big Bitcoin guy. So I would think if I was a Bitcoin guy and I wanted to buy something that might be worth a lot in the future where Bitcoin is right and Peter Schiff was wrong, I would want one of these. I would think it'd be a rare thing to commemorate just how wrong I was. Now, if I'm right, and Bitcoin crashes, well, then I think the value is the art. But again, gold could go way up. I'm still a famous guy. I could be a lot more famous in a world where gold does what I think it's going to do, and I become even more well-known for that. You got my original signature on this piece of art in addition to the signature of the artist, So it could be worth something a lot more than what people pay for it. In the future. So there's something real here. And I'm doing this also because I like the artist. I think it's an interesting project. I'll see what kind of demand there is for something like this. Maybe we'll do more in the future. I don't know. We'll see how well this goes. But again, remember, I had this painting made for myself, and I like it. I think it's a nice painting. It looks better in reality. So that's why you should go down if you want to bid on the actual painting. You should go to the gallery in New York so you can actually experience it in real time, right? That not just looking at it on a paper. If all you want is the ordinal, then But again, you can't just get the ordinal. Everybody's going to get an actual print. Sometimes I saw a lot of these auctions when they were doing these NFTs, and all you got was the NFT. There was nothing. You were just buying the NFT. Here, you're buying the print, right? The NFT, as far as I'm concerned, that's just a freebie. I'm throwing that in, right? I'm selling these prints. You're going to get an NFT. Maybe it'll be worth a lot of money. I have no idea, right? I don't think so. But again, people in the Bitcoin community, you guys all disagree with me. So if I were you, this is what I'd be buying. I think that if I turn out to be wrong and you guys are right, these 50 ordinals are going to be worth a lot of money in a world where I'm wrong. So if you think I'm wrong, then this is what you should be buying. And, and if I'm right and you use your Bitcoin to buy these ordinals, which, you could use your Bitcoin. If Bitcoin goes to zero, at least you're going to have a print. Because if you just hold on to your Bitcoin and I'm right and they're worthless, you got nothing. At least you could take this print and hang it up on the wall, as a testament to your stupidity, right? That, you could have bought real gold, but you bought Bitcoin, and now all you have to show for your Bitcoin is this Peter Schiff print of a bar of gold. Anyway, that's it for today's podcast. Again, my next podcast is going to be live from London over the weekend. I'm going to talk about the jobs report that's coming out on Friday. It's not going to be in the evening like I normally do because I'm 6 hours ahead. So it's probably going to be earlier in the day, U.S. time, because of the time change in the U.K. But I'm only going to be there for 6 days. Again, ironically, I'm talking at this blockchain conference in London on Friday morning. I mean, the first thing I have to do, I think I talk at 8:30 in the morning, which is like 4:30 my time or so. I'm barely going to have any sleep going to do my talk. I'm going to be talking about tokenized gold, about how you integrate gold into the blockchain and how that's the solution, that Bitcoin is in gold 2.0. Gold is gold 2.0. Gold on the blockchain, tokenized gold, cryptocurrencies backed by gold. That's the future of blockchain as far as I'm concerned, not Bitcoin. And again, that's what my ordinals are claiming. By marrying my gold and the blockchain, I'm saying that gold is the future of blockchain, not Bitcoin. But anyway, when I get back from the UK, I'll be back in Connecticut for a while. I'll be doing the podcast from here until on the 26th. I leave for about a month vacation in Europe, and I'm going to take this laptop that I'm using now, microphone and camera with me, and I'll be doing my podcasts on the road. Maybe I'll run into a few. They shouldn't have raised rates as much as they did. That wasn't the mistake. Had the Fed stopped raising rates a few months ago, let's say they stopped at 4%, and they said that we're done, the dollar would have tanked. Inflation would have soared because people would have seen that the Fed is not really willing to fight inflation, and they would have had to reprice all these assets. The gold price would be $1,000 an ounce higher at a minimum had the Fed stopped sooner and not continued with the pretense of fighting inflation to the bitter end and making sure it goes down to 2%. Because had they stopped hiking, they couldn't say that. And so in order to avoid that catastrophe, they had to keep raising rates. And so now we're going to have this catastrophe instead. But every choice that they were going to make was going to have a bad outcome. That is the box that the Fed put itself in. It was going to be damned if it did and damned if it didn't, right? So it did, but it was still damned. Now, even now that everything started to collapse, because at least the last couple of rate hikes, they looked around, they hiked rates, and there wasn't a complete implosion, right? Again, it's like you put a straw in a camel's back and you look around at the camel, he looks okay, and so you put another straw up there and, all right, still standing. But then you finally put one and it's just one too many, and then he starts to buckle, right? So now, okay, we can't put any more straws on, right? The knees are buckling. That's kind of where we are, although they maybe regret that last quarter point. That might have been it, right? I don't know if they're about to reverse that. We'll see. But that added a lot of weight to that crippled camel. But how would they not know that this was going to happen? But because they don't get it, right, that the government caused this and that it was inevitable, they still think the government can solve the problem, right? They're looking for more government solutions. They don't get that the government solutions caused the problem. But also, they expect what happened in 2009, 2010 to happen again. The reason these bond yields are falling
is because everybody assumes recession. Now recession is inevitable. Forget about this soft landing. That's now impossible because we now have this financial crisis or banking crisis, and that means a soft landing is impossible. Now, of course, it was always impossible because this banking crisis was always inevitable. It's just that the people who were predicting a soft landing, see, they didn't get that. They had no idea what they were talking about. And that's why they think that, well, this is just some coincidence. It just happened to happen, like, and interfere with this rate normalization. Oh, my God, it rained on the Fed's parade just out of nowhere, right? And so they assume that we're going to get this recession, and they assume that the recession is going to allow rates to fall, in particular because they assume that the recession is going to solve the inflation problem, that the Fed's rate hikes aren't going to solve the inflation problem, but it's the weak economy that's going to solve it. Because part of the reason we had inflation, people think, is the strong economy, the strong labor market. Well, if we have a recession, we get some unemployment, we don't have this hot labor market, people think prices are going to go down. That is where they're wrong. Because as I've been saying, again, since the beginning, since 2009, when the Fed does this, it's going to accelerate the inflation problem that they had to ignore in order to turn their attention to the financial crisis and the economy. And again, they're not just bailing out the banks. They're going to be bailing out corporate America. They're going to be bailing out the U.S. government because everybody borrowed too much money during the time period where rates were artificially low. Governments, individuals, corporations reacted to the incentives that the Federal Reserve was creating. And those who didn't, suffered. Again, that was part of the moral hazard. If you were taking a lot of risk, then you made money. And your competitors who didn't want to take the risk didn't make money because they were worried. And so they lost out on customers. They lost out on business. I mean, the government rewarded aggressive risk-taking, and now they rewarded again by bailing out the people who took all those risks. So the market, the bond market, is pricing for a recession in which inflation comes down. But the recession they're going to get is going to be stagflation. It's going to be with inflation surging to new highs. And then I think when this finally happens, even the village idiot is going to get it, right? When all of a sudden the Fed's balance sheet is 11 trillion, 12 trillion, when we're in recession, but inflation now is double digit, nobody is going to believe that the Fed's got this under control, that the Fed's got any tools in that chest to return inflation to 2%, unless it's willing to completely crash the economy and bankrupt the U.S. government, which we know it's not willing to do. And ultimately, the Fed and everyone's going to have to say, well, we're going to have inflation, and they'll probably blame it on capitalism. They'll blame it on the speculators. They'll blame it on everybody except themselves. They'll never accept responsibility. A politician is never going to do that on either side of the Atlantic. But investors had better be prepared because that is the outcome. And we're going to have not just a financial crisis. This is going to be a currency crisis and then a sovereign debt crisis. And that's what I've been saying since the beginning. The only thing that surprises me is how long it took. Nothing that's happening is a surprise to me. Everyone in the financial media, all these economists, everyone at the Fed, they're like totally in shock, at least publicly, by what's happening. No, I've been waiting for this. It's all long overdue. It was going to happen. There was no way around it, as are the consequences that still await us. The fact that when the Fed decides and when the government that they're going to bail people out, they're going to bail banks out, inflation is going through the roof. That is the choice. The reason that we were able to get away with it last time don't exist anymore. We're not going to have another 10 years of can kicking. That's done, right? We're out of road. And so we're going to pay the immediate price for this action. Now, whether a lot of people connect the dots because they might say, well, we didn't have inflation last time, so why are we having it this time? The inflation we're having this time is still a result of what we did last time. It's just finally caught up to us. I want to go over some of the economic news that came out just in the last couple of days since I did the podcast on Wednesday. And by the way, in case you're not sure, I had a birthday between that podcast and this podcast. So this is the first podcast I've done in my 60s. And some of you have wished me a happy birthday. I see some of that, so thank you very much for that. And but I'm doing everything I can to stay young. I spent almost 2 hours this morning in a hyperbaric chamber. I do my work in there, so at least it's not 2 hours of dead time. But I get to breathe the pure oxygen under a couple atmospheres of pressure. And I just started this. I'm doing this now, and I'm doing a lot of stuff. I'm waiting for my my cryo chamber, and I've got this red light bed. That hasn't hooked up yet, but I'm doing all this stuff: sauna, fasting, working out. So I'm trying to stay young, right? So I can continue to do these podcasts and enjoy my life in my 60s. But I'm not going to do the Q&A today following this podcast because I do have to get ready. We got this pretty big party going on at my house, but I may do a locals Schiff Premium live special on Sunday night again, because maybe there'll be some announcement over the weekend coming out of this plunge protection team. We'll see how the markets react. So if there's something big going on, you won't have to wait until the Monday podcast. I might go live on Sunday and start talking about it. So if you want to make sure you don't miss that, then go to schiffradio.com/premium and sign up, become a member, and then you'll be ready. And if I do something, well, you'll get notified and you'll be able to participate, and you'll be able to ask questions and have your question answered. But anyway, getting back to this economic data that came out again, that validates, my stagflation forecast. We got the Chicago Fed National Activity